All right, in this lesson we're going to talk about the dividends received deduction and what does that mean and how to calculate that. So why do we have this dividend received deduction for taxes? Well, it comes down to this, and this is kind of a simplified example, but let's say Corporation A decides to partner up with another corporation or even buy another corporation, so they own 20% of Corporation B. And let's, for whatever reason, Corporation B also owns 20% of Corporation C. Well, what happens is, let's say Corporation C then makes money. Well, if they make money, and in this case, let's say that they make $10,000, okay, 20% of that in a dividend would go back to Corporation B, okay? And then, you know, same thing there, 20% would go to there, so that's $400, okay? So we kind of see how Corporation C would make some money, Corporation B would make money, and then Corporation A would make money because they own all of these structures and all of these corporations. But the one thing that is a problem here is that corporations don't receive a preferential tax treatment, which means all dividends are taxed at ordinary rates. So we talked about, you know, individuals, when they receive a dividend from a corporation, they get a preferential rate of 15%. Or 20% or even 0% if they're in the right tax bracket. In this case, when Corporation C sends back a dividend to Corporation B, they're going to send a dividend of $2,000. That $2,000 becomes ordinary income because there is no preferential treatment, tax treatment. So they're going to have to pay taxes on that $2,000 at their ordinary rate. Well, that $2,000 was already taxed over here as well. Okay, so now we have a single tax. Now we have double taxation, and because this $2,000, so they'll pay the taxes on the $2,000, and then let's, again, simple the math, $400 gets sent over to here, Company A is going to have to pay their ordinary tax rate on the $400 that they receive from Company B. So it becomes this double, triple, quadruple tax issue where that same $10,000 is being taxed once, twice, 3 times before it even gets down to even, and maybe even a fourth time when Company A distributes that $400 dividend to the individual shareholders, that's where it stops the line. So that's why we're talking about this dividend received deduction. Congress wanted to find a way, a simple way to say, hey, we know we've already taxed this once, we obviously want to tax it again, but we're going to give you a tax break somehow, and we're going to do it in the form of a dividend received deduction. So let's give you a real-world example here. In this case, we have a $1,000 C Corp, and then they take that $1,000 and distribute it to B Corp. So C Corp distributes to B Corp. Now, the dividend received deduction tells us that depending on your ownership, and that's the next chapter, so we're not going to talk about it here, but depending on your ownership, you can take a 70% dividend received deduction, an 80% dividend received deduction, or 100% dividend received deduction. Now, this is a dollar-for-dollar deduction. So here's the example of this $1,000 C Corp. The $1,000, and in this case, they would get a 70% deduction. So they would get a $700 dividends received deduction, which means they would put on their tax return $1,000 received in dividends, but then they would deduct $700 from the $1,000 to get $300, and that's what they would pay. Okay, and they would use for their tax calculation. So if their tax rate, for ease of math, is 10%, they would pay 300 times 10%. That gives us $30. So they would pay tax on $1,000, only $30 because of the dividend received deduction. Instead of, and again for the ease of math, let's say it's 10%, they would have had to pay $100. In this case, they only had to pay $30. Okay, so that's kind of how the dividend received deduction. All we do is we take how much dividends they would receive from the companies that they own, and then apply the proper percentages to get the dividend received deduction, and that deduction we subtract from what dividends that they receive. So let's give you a side-by-side on kind of how this happens and this whole double, triple taxation here. So Company C has $1,000. They distribute that dividend to Company B. Company's B tax rate's 35%, which means they would have to pay $350 in taxes for this $1,000 that they received. Okay? So what would they have left? Well, they would have $650 left. Let's again assume that they distributed the entire dividend amount of $650 to Corporation A. Well, Corporation A's tax rate's 35%. So on $650, they would pay 35%, so they would pay an additional $227.50 in taxes. 35 times 650. Now, we haven't even talked about what C Corps would have paid in taxes, but notice here we've already paid over $500 in taxes. So not only have we been taxed at the C rate, we've already also been taxed at the B rate and then the A rate, which means on $1,000 net income for Corporation C, we only are left with $422.50 if we take this as a whole. Okay, why? Because over $500 was sent to the federal government. Now, I know it's small over here, but this is what would happen with a dividends received deduction. So we have $1,000 that C Corp is going to distribute it to Corporation B. Now, they get a dividend received deduction of 70%. So if they're going to get a dividends received deduction of 70%, we would deduct $700, and then we would get $300. 300 times 35% is only $122.50. Notice $122.50 versus $350. So there's a difference there. Now, after we've done that, we had $1,000. We subtract the taxes that we would have paid, which is $122.50. So we would have $877.50 that we could distribute to Company A. Okay, so we've got $877.50. Again, if Company A gets a 70% dividends received deduction, that's 70% of $877.50. That would give us to $614.25. Okay, and then we would get an amount of, looks like around $200. So then we would take 35% of that, a little more than $200, and we would get $91.96. So instead of paying $227.50, we're only having to pay $91.96. So at the end of the day, because of this dividend received deduction, we're able to keep $784.54 versus $422.50, almost double. Okay, so that's what the dividend received deduction does. It kind of reduces this double, triple taxation that's going to occur, especially when businesses own other businesses, or they own a lot of businesses, or you have a chain effect here where you might have Corporation A owning Corporation B, which owns Corporation C, which owns another Corporation D, and then there's another partnership. And that happens a lot with tech companies, where you might have Google here, but then they invest in a whole bunch of other companies, and then they also invest in a whole bunch of other companies. So dividend received deduction kind of helps. It's a very easy calculation. You just take the percentage times the dividends received. That's the deduction. You subtract the deduction from what you receive, and then that's kind of your net income. So in the next chapters, we'll talk about how these are favorable adjustments or unfavorable adjustments. This would be an adjustment that you would have on the tax return for $700 in this case.